All right, good evening, guys. Ken at Tortoise Capital. This is Foundation's Q&A check-in for September 21st. I didn't see any questions in the email, so I just have a collection of quick topics to hit, broadly speaking. One of these is that we're at a critical state in the S&P. And one of the ways we know that is this comes from that weekly report where I'm looking at the 10 excuse me, I'm looking at the 10 indexes in the world market model, of which these 4 are U.S. and these 6 are globals. And each one of those controls about 10% of the allocation model, of the theoretical allocation model. And last Friday, we were at 30% invested, 70% cash was the theoretical model. Which meant that last Friday, well, actually 2 Fridays ago and this last Friday, because it was also 30 and 70 this past Friday, 3 out of the 10 were on buy positions based on a comparison of price to the 4-month moving average filter. This week, all 3 of those, which were the S&P, the Qs, and mid caps, those 3 flipped over into cash, and so now the model is at 0% invested, 100% cash is the theoretical model. Now, what that means is that if there was money in the bowl, and we saw an opportunity coming along, could we take it? If our portfolio is more exposed to the world than the recommended allocation, then we can't take the opportunity. But if, for example, last week, if we had been 20% invested and 80% cash, and we saw an opportunity, well, then we could take it because we could add to the exposure up to 30%. So we could actually take that opportunity. But today, the market rolled over, and all 3 of those are now below their 4-month moving average. And that puts them on a cash position. Now, this changing asset allocation never gets us out of a position. When we get into a position, it's because we studied it and we saw an entry and an exit with a reasonable price target. Oops. And with that much risk, we saw at least 2-to-1 risk to reward. So we took the trade, and then we have rules in the ETF2 system that describes how you adjust the stop that pertains to that particular trade. So we place our faith and discipline in the exit rules that manage the specific opportunity that came about. What this theoretical model does is prevent us from taking money out of cash and dumping it into a world in which the broad indexes are clearly crashing. So we don't want to add to our overall risk exposure. But once we are in a position, we use the exit rules of the system that we're in to govern when we get out of that position. So I just want to make that point. Now, this is a model that I publish every weekend, but the guys that are long-term asset allocators and swing traders, and a lot of our professional money managers have that same spreadsheet so that they can assess those conditions on their own. That turns out to be one of the best ideas I've had in the last 25 years. Turns out. Another one of them is this idea that the risk Z is another one of those ideas. It's turned up to be pretty useful. And this compares the 10-period simple moving average of VIX versus the 30-period simple moving average of VIX. And that ratio has a certain value between, if they were equal to each other. See, under normal conditions, the VIX is decaying, and then there's a volatility event, and then the price of the VIX goes way up and then slowly decays. So if you took a look at the 10-period moving average, it would look like this, and then it would spike way up and then slowly start to roll over. And then the 30-period, which I'm going to draw as green, I should have. The 30-period is going to look like this. And under normal conditions, you know, when you get this rollover, when the 10-period is less than the 30, then that's good. Because that means that the overall VIX is dropping. And so when the VIX is dropping, if you were to take the most recent 10 days and compute the average, you'd be right there. And then if you took the 30 days from here, and you go back up into here, well, the average of that would be here. So when things are good and the VIX is falling, the losing volatility is always good for the long-term posture of the market. So when you have these long volatility decays after a volatility event, well, the 10 period is always going to be less than the 30. So when we divide the 10 by the 30, if the 10 is less than the 30, then this number is going to be less than 1. When they are exactly equal to each other, it will have been early. It will have been early in the decay, and that's the parity point. So at 1.0 is the balance point. When it's less than 1, then that's good for stocks. If it's greater than 1, that's bad for stocks. And so when that number is 1.0, this shows, I'm sorry, I said that wrong. 30 divided by the 10. We want that to be greater than 1. When it's above 0, that's a good thing. That makes that the summer. When it's rising, that's good because things are getting better. When it rolls over into the fall, it's starting to be troublesome. When it's in the winter, that's bad. So I said that backwards. So this little emotional roller coaster sort of maps the same kind of psychology in terms of feelings that the numerical value of the 10 and the 30 looks like. So that's one that we update every day, and I use that in the same way that I use the money management and asset allocation rules of this model to help me decide when to get into new positions. So let me review real quick where we are right now. We've had a couple days of just absolute misery. And let me pull up the daily health check on the chart, and you can see what I mean. Yeah, so on the 150-day look back, this is coming all the way back to here. That's the 150. That's the 150-day high, which hit right here, and the 150-day low hit way back here. So we've had a nice run, but lately we've had 2 legs down, and then this lower high is setting up a problematic condition for us, right? So this being the 150-day high and the 150-day low, this being the 30-day high, and the 30-day low was made today. So that's actually bad. And we broke below the previous 30-day low here. So we actually had a collapsing dragon form today. And then you notice that the next support level is over here. So there's nothing between 431 and a half and 415. That's $20. That's 5% of nothing to support this market. So this is really problematic. Now, if we zoom in and look a little more closely at the 30-day block, let me also just point out that this is the volatility of the 30-day, from the 30-day high to the 30-day low. This is the blue box is the volatility of the. Sorry. This is some sniper thinking. This is the volatility range of the 150-day high and low. And this is the volatility of the 30-day, which you can see is becoming more volatile because it's about 1/4 of the size of the 150-day, even though it's only 1/5. It's only 1/5 of the time. It's about 1/4 of the range. But what's really problematic is that the last 10 days have gone from here to here. So the 10-day volatility is almost as large as the 30-day volatility, and the 5-day volatility is almost the same as the 10-day and the 30-day. So the point of this is to say that's how bad things can get in 5 days, which is why I believe if you're a long-term buy and holder, you have to protect against these murderous 5 days. Like, for instance, this stop right here was absolutely crucial to protect against that sell-off. So I just want you to notice how bad things can get in 5 days. And then this little piece here between the red, that's the 1 day. So that's the 5-day, that's the 10-day, that's the 30-day, and that's the 150-day. So you're getting a sense of why in the shorter term you need to be a volatility trader, whereas in the longer term you can be a position trader or a relative strength trader. And this is a little easier to see if we zoom in on the 30-day. So now that black box represents the 30-day range from the high to the low. So we made a new low today. Before that, the previous 30-day low was here. The statistically 30-day high, the previous 30-day low, new 30-day low here. The statistically significant 30-day low was here, where the belly of the RL10, so that's why this is the important stop at 436.31. So when today gapped down below that crucial price level, that was an indication that all hell was about to break loose. And then you see that there is a large range day today, which was mostly directional because it opened here and closed there. So today's move basically was net all down. And then if you look at the Four Seasons of MACD, you realize this is just beginning to enter the winter. Like today and yesterday to today was the beginning of winter. It just tipped below the dotted line at 0. So this is just beginning to fail, and there's no support all the way down to 415, which was something like 90 days ago. So that's problematic. It's even more pronounced if you look at the 30-minute chart. So now you can see what this looked like. Here's today's price action. This is the 5-day price action from the high to today made a new low. And then here's the 10-day. The 10-day look back, the 5-day look back, the 1-day look back. And you can see this has been kind of an orderly sell-off until the Fed said something, and then this whole thing collapsed. It collapsed below the collapsing dragon, and then everything got murdered yesterday. And then today there was a big gap down and just a horrible move. So that is the threat to tomorrow's move. We've gone from 453 to 431 in 5 days, which is minus $22 on 453, which is about minus 5%. And then a move to 415 would be another minus 16, which would be about another almost about 4.5%. So this would represent a 10% sell-off from the 10-day high and more than a 10% correction from the previous swing high. So we are in day one of what is kind of officially potential disaster, which sets Friday up to be an interesting day. Tomorrow will be an interesting day because today was a panic Thursday, and tomorrow is the last trading day before the weekend. So now you got to ask yourself, how many people want to take positions on a Friday and hold it over a weekend and wait for 48 hours of news cycle, which has nothing positive to say? So tomorrow, to me, looks like an opportunity for a tactical day. Now, when we look at the daily report, we saw there were a lot of 5-day downs. So I just want to take a quick look at those. Just to show, that's one of my favorite moves. So if you'll bear with me half a half a second. All right, so here's a 5DD, and these are all from the, you can see them all in the daily report. All right, so this vertical blue line here on these next few charts is always showing the 5-day look back. And today is the 0-day where we're stalking it. The yellow box represents the yellow zone, so today's high will be the green line, today's low would be the red line, and that makes this the yellow zone. So that becomes the directionally neutral box, and then a breakout above that gets us into the green zone where we want to be long, and then a break below the red line is below yesterday's low. That's the red zone, and that's where we want to be short. And then the 10-day high is going to be represented by that purple line, and that represents the reward to risk ratio. So I treat the 10-day high as a reasonable reward. Like, you're not allowed to be surprised if it got back to the 10-day high, because it just did that in 10 days. It could do that in 10 days. So we treat that as the reasonable, not crazy reward. And then for computing reward to risk ratio, mechanically, all I do is take the size of the reward and divide it by the size of a mechanical risk, which is the 1-day range of the setup day, and that becomes the reward, or the reward to risk ratio. So the ones I'm going to show you here are showing better than 2 to 1. So this one's about 3.5. This is in Boeing. And you can see that we've had 5 days down in a row, and that's the criteria for the 5DD. This is actually a 6DD today, because the 6th day, the low was, so we actually had 1, 2, 3, 4, 5. 5 days down, I should say. Yeah. Whereas this was the last time we had a higher close. So that's exactly what a 5DD looks like. That's how we set up the trade frame. That's how we compute the mechanical reward to risk ratio. And then on the daily report, you'll see Boeing flagged as a favorable reward to risk ratio with the 5DD. See if I still have that open. Oh, I thought I had it open. Nope. All right. All right. The next one is.
Ken, do you mind if I ask a question on that
Go ahead.
chart?
Yeah.
The 5DD on the chart that you were looking at previously.
Yeah.
It has it's a harsh winter too, right? Because we have the PSAR flip and it's
Oh
going
yeah,
down.
yeah. So the mechanical swing system of a 5DD just means that there were 5 lower closes.
And
It doesn't draw on any of the other information available, but you can see that we've got a harsh winter, and it went into the winter here, and you'll notice that there was actually a collapsing dragon here. So if I'm doing advanced swing trading and I'm using RLCO patterns to swing trade on daily charts, this one was a big time sell because it broke below this day's low, and it also broke below that one. So this is where we should have been short. We should be short Boeing from 220 and it's down at 199. So that's a 10% move. And oh, by the way, if your risk would be the top of the Dragon or the PSAR, which is it's either a $5 risk or a $10 risk, and you made 20, so you're either holding a 4-to-1, a 4R, or a 2R just on being short at that location. So yeah, so the 5DD is a mechanical system that only requires 5 lower closes. But if you are following along with our chart framework, then you also notice that there become other opportunities, like this one had. This was also, and as soon as this breaks through the Dragon right there, you would also notice that as a Kata 2 to the downside. You would also have noticed this as a PSAR flip. So you could actually be short from this pig at about 232. And if you play that way, then you get this trade. There's your risk. And where you think it's going to get to, if it fails, would be back here, which is where the previous support level was. So when this thing, notice how it kind of hesitates around the support. And when it breaks, that becomes decisively down, which led to the 5DD, which you just get that signal today. So if you had been short here, you probably, after this move, you should be taking that as an exit at the edge of the Dragon, because you've already given back that much. But then you re-entered short here, if you're playing this properly. And now you have an opportunity to have added a second position here and possibly a third position there tomorrow. But the point is, if that thing fails tomorrow, you get a 5DDF. But if it reverses, then you should exit the swing trade here, because now you got a long signal, which says it wouldn't be crazy to think that this thing could rebound all the way back up to the 10-day high. So that's sort of a blend of different strategies of swing trading and using the sense-making framework that we use for RLCO. Check or hold?
Jack, fun follow-up question. Is there any move that invalidates a harsh winter other than
No.
just the seasonal change?
No, what it takes to change it from it is a harsh winter until it becomes a spring.
Okay, check. Thank you.
Yeah. And so in this case, what has to happen for this to become spring is that the downward slope has to change. It has to move up. And essentially what has to happen is the RL10, which is here and sloping downward, there has to be enough price action to the upside that the RL10 reverses and hits the PSAR, which is decaying. So somewhere around here, it would probably take 3 or 4 days of buying pressure for this winter to become spring, because it doesn't flip until the PSAR doesn't flip until the RL10 goes through it. Here's another 5DD. This one is on Devon Energy. Now, you'll notice that this one is even more violent, which is one of the reasons I love trading Devon Energy, is because it is so violent. Here's your 10-day high at about 53.3. It was still in the summer. Notice that it flipped pretty much where you would expect to resist, because it got to here and then failed to here. So now this becomes our support level on the downside, right? So when this PSAR flips and we get this move, We're not allowed to be surprised if it gets back to the previous 10-day high, which it did. And when that rolls over, you have to be out of that by the edge of the dragon. So your reasonable swing trade on this one, following our standard rules, would have been that. And then what you're doing is you're hoping to see it find support in here and reverse higher, and then that would become a kata 2. And then this would become the buying point for an emerging dragon. And then this would be a kata 2 entry somewhere in this region. That would be an emerging dragon in that region. But it didn't do that. It got to here and collapsed. It collapsed through that support level of the PSAR. And now the summer became a fall, and then right here became a winter. And now we've had 2 harsh days of sell-off and closing poorly. So this signaled a 5DD today. Let's just verify that that's true. 5th day down, 4th day down, 3rd day down, 2nd day down, 1st day down. That's the point where it turned. It went from here and then closed here, so that was an up day. But then it had 1, 2, 3, 4, 5 days down, and now my trade frame becomes this yellow zone. That I calculate the mechanical entry and as 5 cents above today's high, mechanical sale 5 cents below today's low, then this becomes the yellow zone. And that's a 1R mechanical risk when we're computing the reward to risk ratio mechanically. I now go back to the 10-day high. And then that becomes my reward. And now how many of those do I have? 1, 2, 3, probably 3.5 to 4 to 1 on Devon Energy. Now, the thing to notice that Devon Energy compared to Boeing was how wide today's range was. That's a lot of move. And my MMRB in Devon Energy is usually about 20 cents. So there's actually, if this thing were to open here without a gap and then start moving up during the day, well, if it breaks north of 48, I want to be long, but that gives me an opportunity to use an intraday risk once I see the low of the day and it reverses. And then I could play probably a 4 to 1 trade just to the top of the yellow zone. And then if it breaks through there, then I can use market's money that I earned on the intraday trade to fund the risk on a potential return to the 10-day high. And so we would call that swing trading 1 day at a time. Is finding these very favorable reward to risk ratios, finding opportunities to do some intraday turbo, and then if it makes a mechanical entry, and I could still have a swing trade based on where I was able to get in, and I have price improvement, or I can also just make money on the intraday trade in order to fund the overnight risk. Using price for the 5DD versus the RL. Well, because the high of the day and the low of the day have significance for other traders who do not follow our methods. So how many traders are there that follow our methods? 200 or 300? How many traders are there in the world? 1 billion? So you have 300 people studying the high and the low of the day and using the RL10 as a proxy for price, and other people using the price itself. Now here's where this becomes an advantage to us. The price level to get into this thing short was where the belly of the RL10 was, which is where the PSAR flips, which if I could draw that better, is right at 49. So we have an alert at 49 that this thing is failing. But people that are using actual price are looking at support at this level at 48.50. So they don't see this. See, we see that as an opportunity for us to get short because it violated the statistically significant support level. Whereas all these guys have their stops below the swing low, and that's why this thing collapses so hard. So we can get a position in here where it's just starting to fail, but the tripwire hits right there when all of those stops that are underneath that level trigger, and that's one of the things that causes us to be such a runaway move to the downside. Did I answer that question?
Yes, thank you. But the price leads the RL, so the price would hit first.
Oh yeah, for sure.
Okay.
For sure. So when I hit, it is a price trigger. I use the RL to produce the trigger. When price violates it, I'm short.
Got it.
Because this doesn't even print. This little dot, remember, this shows as a line, but it's not a continuous signal on the daily. Those are simply the endpoints of where the RL10 prints. So this price was already here yesterday when the RL10 printed right there. But I want to be short there already. So what I do on the short side is that I use the RL10 and the PSAR flip as the trigger, and then when price violates it, I'm in.
So do we want to modulate the RL10 instead of using the close? That if we're predicting a short action, should we use the low? And then
No.
if we're doing a long action, use
Nope.
the high? No?
Nope.
Okay.
Nope. You just, because on this day right here, the day before it broke, we knew what that price level was. That is a precise price level. And as soon as price goes below it, I want to be in. Because the other guys are stacking their shorts here. And everybody that is buying that wants to go long because they think this is support. And so they buy that here because it has sold off that far. They say, well, look what happened the last time it was here. They went long. Yeah, you can use a sell stop, or better, put an alert on it and then execute a market order as soon as it triggers. All right, so this one is, this is Home Depot. Now this one is especially nice from a reward to risk ratio, is because it too has had a large sell-off from 330 down to 306. So it's lost 27 bucks on 330, which is minus 9%. But the range today was actually low, so you actually get about a 6-to-1 reward to risk. But the beauty is that thing already, and it closed poorly. So as soon as this thing fails, it's already so deeply in the winter. There's no support in sight. So if this fails, it's going to fail huge. So this sets up a perfect zero state. I don't care where it goes. If it breaks this way, that's a good long swing. If it breaks this way, that's a good tactical intraday short. here's Microsoft. The sell-off in Microsoft just began. Although there was one big sell-off, here was the recovery, which was nice, to a 10-day high. And the 10-day high only happened 6 days ago. And it sold from 340 to 315. But notice what it did today. That almost constitutes a bottoming tail. So if you put a nice tight risk box around that, you get an intraday trade in the yellow zone in both directions, and then you can add to that position if it breaks above 325, and you could add to the position short if it breaks below 315. So here is your intraday tightly managed risk box. Here's a tactical trade of 3 to 1 here and of 2 to 1 there, and then you put second positions on here or here. So Microsoft, if it actually holds here and takes off, you would say, oh, it held support right where it's supposed to hold support. And then where could it go? Where could it go the last time it held support here? It went to here. So that makes this a rational price target to the upside, and you can get in and build a nice position with a very tight risk box right there. So Microsoft is a special case. So this is advanced hybrid trading. Here's one in 3M, which is pretty nice. You got the rollover here. You got lower highs. You had a collapsing dragon today. It closed poorly. It's a 5-day down, and it just started into the winter. Well, except if you looked at that, you would say that's a pretty harsh sell from 109 to 97. That's minus 12. 12 on a price of 109 is minus 11%. That's a pretty significant sell-off. So I would treat that as a harsh move, and it's below this. But the good news is it hasn't even begun to become harsh winter here yet. So I set this up again as a zero state. I'm ready to go long from here or short from there, and I'll play either one of those on an intraday basis. So from the last time it went into winter, it stayed downward for seven days. So if that's day one of the winter, this thing could be down for 6 more days if history is gonna repeat. So a 5DD failure is an auto short, especially when it's already a collapsing dragon. So just as a quick review, if we're looking at our day trading patterns, we have first generation and second generation RLCOs. We have a mixture of signals and patterns. We have frog techniques. And then we have certain statistics-based techniques that help us frame trades. We manage the trades with a bunch of statistical techniques. In swing trading, we have purely mechanical signals. We have a rules-based ETF2. We have more relaxed strategies that allow us to frame trades with a little more flexibility. If we have a trade that works and then it holds support and takes off again, we have continuation patterns on both of those sets. And we can use all of the patterns that we use intraday on daily and weekly, and on daily 3-day, and weekly charts with all of those patterns that work on the intraday basis, the same way that you see me doing them for the hybrid. And then finally, we have some additional ideas from longer-term swing trading and core and position trading that allow us to work on management and stacking the deck in our favor, like knowing how to blend core and turbo, knowing how to manage our money professionally, understanding what our histograms tell us, using the trade index analysis to look for opportunities that our rules might have missed. And then we know how to frame the market in different time frames in order to evaluate opportunities. So all of those things are things in our advantage. Yeah, go ahead.
Hey, Ken, I apologize because I don't know everything on this slide fully, but I'm going to ask the question anyway. Are all these different systems you have already resolved? They don't conflict with each other, right? So in a way, they all work on a standalone basis.
Yeah, I think so. They're like golf clubs. And what I look for are the ones that really resonate with me. Like the owl is a very relaxed pattern. Like all of these right here, I don't even trade those as patterns anymore, but I use them for information when I'm documenting what the trade frame is. Like I love the collapsing dragon, the owl. The pocket trade is really what I'm calling the Kata 2 now. At the time I wrote this one, I didn't even have it named as the Kata 2. I love the Z3 pinch. So I love the auto framer for swing trading. But these are, different patterns resonate with different people. I love the RLFF for setting up swing trades. The main point is that, yeah, there's a lot of different signal generators that can get me interested in it. But once I'm in the trade, the way I manage them is all basically the same. I use the same standard trade management techniques for where to put the stop. The PSAR, or a trailing 1R stop, or the sniper exit, something like that. But really, it's the PSAR. So many ways to get in, one way to get out. And that gives me synergy in every time frame. Does that answer your question?
Yeah, no, that makes sense.
Yeah, so what I'm trying to give you in the foundations is the minimum mission essential things. Right? Like I'm trying to really concentrate on the Kata 2, the owl. See, I don't even have the SSC and the Kata 2 in here because this was a chart from 2019. So I would add those two to that list of second generation. So if you did Collapsing Dragon, SSC, Kata 2, and the owl, I think that's plenty.
Ken, would you ever double book?
Meaning?
Would you do two
No.
two different systems? Okay, got it.
Nope.
Yep.
So if I have a symbol and there's 4 different signals for it, here's what I would say is maybe if that was like the mechanical frame, so I could get long here with the stop here, but intraday I could get this. I know that if price goes through this one, I have a decision to make. I could either put a second position on because the fact that it fired on that frame gives me more confidence that this thing still has room to go because it just started to go here. I know that I still got a reasonable 2R above all the way up here. But it just happened that I got price improvement. So I might have 2 or 3 different reasons to get into this thing. but I like maybe one or two positions on it, and I just like to know where those different price levels are. So if I can't get this one, then I can get this one. So that's like a price ladder on the way up. But if it rolls over and starts to fail, I get out of all of them at the same time. So I increment in and then all out. Tip when I'm doing day trading and that hybrid swing. But it's like the mechanical signals here, the channeling and the overaction. It's not unusual to see that the 5 days down also made it a channeling signal. So, but I'm not twice as convinced that that's going to work because there is some overlap in there. So if this was channeling, 5 day down might look like this. So there's a lot of overlap, and it's just a really good signal. But I could get channeling without 5DD. I could get 5DD without channeling. And that has I'm confident in both of those signals. But when they both fire, I'm not betting double on it. It just means that there was overlap. Okay, yeah. Let's see. That's just another way of expressing whatever usually on swing trading, the previous day's range is today's yellow zone. I can trade in the yellow zone if I can see 2 to 1 inside the yellow zone. But my mechanical entries are when it breaks above the high of the day or below the low of the day. If I'm in the green zone, I want to be long. If I'm in the red zone, I'm looking to be short. Why does price vary so much? Well, every one of these things contributes to a certain extent on the difference in returns and in the variation. The size of the company or the sector, the kind of an asset it is it growth, blended, or value? What region of the world is it in? Is there anything happening in the currency with that country that it's in? Is there something about it as a U.S. sector or a global sector that's influencing it? So the geography, every one of these things can vary from everything else on the inside of that box. So when you start putting all those things together and you say, why is that thing moving differently than the other peers? The answer is some combination of all those things, and you can't know all of them. So when I'm looking at the world, I look at it as a competition for capital, and that there may be some underlying causal model, but it's probably a black box that we cannot know. But what we can ask is, if we observe the results, what's working, what was working, what's starting to work, what's starting to lose, what's the context, what's the frequency and amplitude of the volatility, what's the current best heuristics, what degree of confidence can we assign to our insights, knowing that the underlying causal model, this black box, is invisible to us because it is filled with all sorts of information that may or may not be important, and there is a variation and a dynamic change in all of those. And all of the actors and the agents that are in the market all have these different characteristics, and those change because they're emotional beings. And people are coming into the market and out of the market, and they have different time horizons. So when you put this times that, times all of these variables, you cannot possibly expect to have a definitive causal model. But what you can do is just treat it as a observable competition and ask useful descriptive questions to find out where the odds are and try to not get trampled by the herd, and to have independent judgment. So that's my view of the complex adaptive system of the world market model. And I think that what that means is you got to decide inside that complex world how you're trying to feed your tribe. Who are you as you try to feed the tribe? If you are on, if you're above the line, then you're hunting for protein. You know, you could be a big game hunter. That's your role. You're going after the dangerous large herd animal, and the way you go after that as a hunter is different than the way you go after a bunny rabbit as a hunter setting a lot of snares. You don't have to worry about the prey turning on you and killing you. But here you better be very careful on how you hunt mammoths. Like, you may want to climb a hill and push a boulder up a hill so it is precarious, and then there is some little valley in here where the mammoth or the buffalo have to go through this choke point in order to get to the watering hole. And so if you get your capital and you see the herd moving through here, maybe you can roll that thing down and kill one buffalo and then feed your tribe for 3 months. And then the buffalo can't charge up the hill to stomp you to death. But if you try to use bow and arrows inside here, that's a slightly riskier proposition. But the timing is easier than if you're trying to drop boulders on them. But you got to decide how you're going to go after this animal in a risk-adjusted way, the same way that you're going here. But if you're below the line and you want to go agriculture, you could go wandering around until you can find clumps and clumps of blueberry bushes and then go pick them. And then keep trying to find more blueberries. Or you could undertake a program of agriculture, so you could be gathering berries, or you could be growing corn and go for industrial strength. So these are big ideas that take a lot of commitment. So the left side is big commitment, the small side is small tactical flexibility. And above the line is hunting for protein, and below the line is plants and vegetables. So over on this side, you're a farmer, and here you're a gatherer, and here you're a trapper, and here you're a big game hunter. Well, there is a psychological profile for each one of those things. And the world has opportunities for all four of those things in different degrees. Sometimes some of them work here, some of them work there, some of them work now, some of them work later. So there can be some combination of these things. And there are ways that you can design systems that are optimized for who you are and what you're trying to do. But it doesn't mean that this system will work for that system. But all systems have certain tangible qualities that we can learn in order to ensure that the system we design is robust and complete. So using systems thinking and learning to understand your identity allows you to organize your behavior in a way that aligns with who you are and what you're trying to do. You had better be competent in understanding all of these biases and logical fallacies, which means you need to be a critical thinker so that you don't get fooled by randomness and data and rhetoric. You want to make sure that you are genuinely an independent thinker. If you are a reader of Stephen Covey, the 7 habits of effective people are these first 7. I added an 8th one, continuous improvement, because I think you can get better at all of those. And if you're not continuously improving, you're starting to get worse at some of those. Sharpening the saw means taking care of your tools and continuing to learn. And then these other things allow you to endure in the difficult world of managing yourself and managing your trades. You might organize your efforts in order to maximize your professional feelings. If you trade professionally, you could expect to feel these things. And those are things that are worth feeling. They feel very, very good when you are professional enough to experience those things. So you can use the satisfaction of professional feelings as one of the things that helps you endure when times get tough. Those professional feelings help you manage your attitude. North of the line is what an amateur thinks. Below the line is how a professional thinks. So when you manage your response to stress or to losses or even to wins, you take professional responsibility for everything, and you work on the things that you can control in order to improve your professional practice. When you're being professional, you might document your preparation for your daily trade. Here's a couple examples of guys who have done that, where they have templated out their operations plan on a single page for each day, identifying targets, time frames, patterns, strategy reinforcement, including a plan for how they're going to assess when the market closes. You might think about adding these monthly review questions so that when you're conducting a formal review of your professional practice, that you have ways to answer these questions. Can you collect the data that allows you to study your performance over the month? That means you got to have a daily checklist to say, today, did I exercise and meditate correctly? What is the thing I did today that I'm most proud of, and what do I regret? So these monthly review questions allow you to get to closure at the end of a significant 30-day period. You might keep in mind that when you are buying a COTA 2, for example, which is what this looks like, that the first mouse, the innovator, buys it because it's sold off so hard. He figures, it's sold off so hard, what could possibly go wrong? The second mouse waits for a little bit of evidence that the turnaround has actually occurred, and so he becomes an early adopter of the idea that maybe that's the bottom. There is a world of difference between first mouse and second mouse. The second mouse is measuring the amount of risk he's taking versus the reward of getting back to the 10-day high. And he's also aware that what if this thing only gets halfway back? Is that still a trade that I want to take? And that's about as far as I go with Fibonacci's. Late mass adopters go maybe after it gets more than halfway across. Late mass adopters as it's testing the swing high, and grumpy old men who wait for it to actually break out and not fail. So in every way, when I'm designing systems and strategies, I'm trying to figure out how I can become the second mouse. And then I try to turn that into rules that allow me with precision to figure out that system for myself. And then when I think about managing risk, which I think about every day, I realize that every one of these bullet points is something that I can do to help reduce the amount of risk to my barn full of grain and jerky that I'm trying to feed the tribe with. That all of these things are ways that I can systematically reduce the amount of risk to my trades, to my portfolio, to my capital, to my psychology. All right, so those are just some of the big ideas from hybrid trading and advanced swing trading that I want to share, that are part of the very broad ecosystem of tortoise learning. It goes beyond the scope of the foundations course to cover all of those things, but you do need to know that those things are out there in the ecosystem for us to consider. What the foundations course represents is the first, best, and most important set of sufficient concepts to get you started trading professionally with managed risk. All right, so that's everything I want to cover today. I want to get ready for the 8:30 and get the reports printed, but take good care, and we shall see you shortly. Keep sending in your questions. Jose, keep up the great work. Same thing, Wallen, Alex, Greg, all of you. Keep up the great work, and see you shortly.